AT&T is a stock which is known for being a favorite among dividend investors. Historically, it provided reliable and slowly growing dividend income. In fact, it was one of the stocks I covered frequently when I started this channel 4 years ago. However, that AT&T investment proved to be a mistake and a learning lesson. I sold after the announced dividend cut and spin out of Warner Bros. Discovery. But in reality, I should have sold anyways regardless of the dividend cut. That said, many years have since passed and the financials at AT&T are starting to improve. Today, I'm going to share whether AT&T stock is finally a buy in 2024. I'll do a full stock analysis and explain what I got wrong about the company. If you stick around to the end, I'll share a model of what kind of return and dividend income you can expect from AT&T over the long term. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. You can sign up for our free email newsletter designed to help you find better dividend stocks. Link in the description and pinned comment. AT&T, ticker symbol T, is the iconic US telecom company. It actually has a very impressive history going all the way back through the 20th century, and being such a strong company, it was once considered a monopoly, ultimately being broken up into what they called the baby bells. And they used those monopoly profits to invest into innovative technologies through Bell Labs. And many of those were building blocks which helped create our modern society. Today, AT&T is a cellular and internet company. Their business is primarily around wireless service, which is the data plans you pay for your smartphone. And then they also have a broadband business, which is the wired internet coming to your homes and various businesses. But the wireless business is the main one by far. And as of the latest quarter, they have 71.9 million phone subscribers at a $56.42 average revenue per user. And this business provides reliable subscription revenue for AT&T. It's very low churn as it's a product everyone needs, so it's set up that you can make a lot of money. However, this is not at all a high growth category as everyone for the most part already has a smartphone. It is highly competitive between Verizon, T-Mobile, and all the other smaller carriers. And just in order to compete, it's incredibly capital intensive as you have to invest in new infrastructure all the time. So that makes this stock analysis a little complicated. AT&T's current stock price is $19.76. Over the trailing 12 months, they have earned $1.74 in earnings per share, which is an 11 PE ratio. The current annual dividend payment is $1.11, giving it a 5.62% dividend yield, and the company is valued at $141 billion. Now, what's interesting is last year they generated $38.3 billion in cash from operations. So it is actually only trading at 3.7 times operating cash flow. However, this is a business that spends $18 billion a year on capital expenditures. So as of 2023, they were still generating $20 billion in free cash flow. So it may seem like it's still cheap enough where you could get a pretty good return on this investment. However, this is a company with a lot of debt. They peaked at $229 billion of debt, ultimately spinning some of that out with Warner Bros. Discovery. And since then, they have been able to pay some of it off down to $147 billion as of the latest quarter. And basically all of the free cash flow they generate goes to repaying debt and their now reduced dividend payment. In the latest quarter, they paid off $2.5 billion of debt and paid out $2.1 billion of dividends. So here you can see the historical dividend growth of AT&T. In 2022, they announced a dividend reduction, which was a decline of nearly 47%. And since then, the dividend has remained flat with no increases, and there has been no word from the board about whether dividend growth will come back anytime soon. Luckily, the dividend payment is now sustainable at a 40% free cash flow based payout ratio and 56% based on net income. And as of Q2 2024, they actually increased free cash flow by 8.7% year over year from $4.2 billion to $4.6 billion. And this is despite cash from operations declining 8.4% year over year. They've been focusing on cost reduction around capital expenditures, decreasing from $5.9 billion to $4.9 billion, which is 17% down year over year. And this is a big focus of theirs so they can continue growing free cash flow. However, this is where we get to the problem and why I no longer own AT&T stock. First off, they have a capital expenditure problem. They are forced to invest tens of billions of dollars a year just to maintain their market position. If they don't compete in terms of speeds around 5G and all of these things, then consumers will switch to Verizon and T-Mobile where they continue to invest. And this is actually similar to what's going on in semiconductor manufacturing. So a significant amount of their cash from operations needs to be reinvested into capital expenditures. It has to happen. And this actually reminds me of one of my favorite Charlie Munger quotes. He mentions that he prefers a business which drowns in cash.
We tend to prefer the business which drowns in cash. It just makes so much money that one of the main principles of owning it is you have all this cash coming in. There are other businesses like the construction equipment business of my old friend John Anderson. And he used to say about his business, you work hard all year, and at the end of the year, there's your profit sitting in the yard. There was never any cash, just more used construction equipment. We tend to hate businesses like that.
It's a lot easier to understand a business is mailing you a check every month.
The idea being where it doesn't need all these massive capital investments and all of the money just keeps coming in. Therefore, they can distribute it as dividends to shareholders or invest it into high growth opportunities. The money just keeps piling up and they don't have to put it into equipment or infrastructure. And the other major problem with AT&T is that there is no growth, none. The entire markets they operate in are not growth businesses. They have no ability to increase prices and they will only marginally grow subscribers. And you can see that here from the future analyst estimates. Earnings per share is not expected to grow at all through 2028, and neither is revenue. If you never grow, it's so hard to generate returns over the long term. And you can see that by AT&T's stock price. It has continually stayed flat or declined over time. And if you buy the stock today, this is what it's going to look like 10, 15, 20 years from now. So the only way you can get returns from AT&T stock is if you buy it dirt cheap. All of that return will come from the dividends they pay you. And the interesting thing is that a high yielding dividend stock can actually provide some interesting returns over the long term, regardless of what happens with the stock price. And I'm going to use my dividend calculator to project out what AT&T stock returns and dividend income would look like over 35 years. By the way, this tool is available for free on my website, dividenddata.com, link in the description and pinned comment. Also, you can get this entire stock research tool I've been using throughout the video and sign up for my free email newsletter to help you find better dividend stocks. All right, so if we plug in the metrics for AT&T, it has a current stock price of $19.76. The annual dividend payment's $1.11. And given that the dividend payment is now sustainable, let's just say they go back to the slow growth rates of prior years. And if we go back and look at their historical growth, that's around 2% a year. And then for the expected compound annual growth rate of stock price, this is the questionable one with AT&T. I'm going to enter 2%, which may end up being generous considering it has actually declined over the past 20 years. But to be fair, we are at a very low valuation for AT&T stock. So let's say you invest $1,000 every single month into AT&T. Over that time, you would invest $420,000 into the company. The total value at the end of 35 years would be $2 million. However, if we dive into that, almost all of that return will be from reinvesting dividends. If you don't reinvest dividends, then the total value of your AT&T stock will be $606,000. Now, to be fair, you would have also earned $500,000 in dividends in those years. Still less than 50% if you had reinvested dividends. So the ironic thing with these high yield, low growth stocks is that the best return comes from reinvesting dividends. And the reason why that's ironic is most people buy these to get the dividend income and they usually take them as cash to pay for their lifestyle, and they choose not to reinvest dividends. However, your return will actually be pretty terrible if you do that. If you reinvest dividends, by the end of 35 years, you would be earning over $105,000 annually in dividend income. And that's actually pretty sweet. That's a 25% dividend yield on cost. And again, this is only assuming 2% dividend growth. So it's possible that AT&T can still be a reliable source of dividend income into the future. However, in terms of total return, I definitely would not recommend the stock. Given that I'm young and have a very long time horizon, AT&T and stocks like this will not have a role in my portfolio. And if you want a live look at my watch list and dividend portfolio, then sign up for dividenddata.com. You can join my free email newsletter to help you find better dividend stocks, and I'll share the learning lessons I had to avoid stocks like AT&T. And if you enjoyed the video, leave a like, comment, and subscribe to the channel. I'll see you next time.